Your parents saved quietly, bought homes, retired comfortably, and expected similar outcomes. You copied their strategy exactly, yet somehow everything feels financially backwards. The strange part is, nobody officially changed the rules you followed. Savings accounts still exist, budgets still matter, and advice sounds identical. Yet, beneath familiar language, the financial world transformed almost beyond recognition. Imagine two workers earning responsibly, separated only by several decades apart. One steadily builds wealth through saving, cash, patience, and ordinary discipline. The other saves diligently too, yet watches opportunities drift further away. Same behavior, different outcome, because the environment surrounding money fundamentally changed. Understanding that shift explains why many feel financially responsible, yet trapped. Start with your parents' generation during decades following post-war economic expansion. Productivity increased rapidly, wages generally followed, and housing remained relatively affordable. Saving money wasn't exciting, but saving steadily gained meaningful purchasing power. A modest bank account could actually earn interest exceeding inflation sometimes. Cash sitting safely often moved forward instead of quietly moving backward. That sounds ordinary today, yet it's almost unfamiliar financial history now. Back then, accumulating cash created options rather than eliminating future possibilities. Years of discipline often translated directly into larger financial opportunities later. Then something subtle happened beneath headlines: politics, technology, and economic growth. Asset prices began accelerating faster than wages across much developed economies. Houses rose faster, stocks climbed faster too. Education costs increased dramatically either. Meanwhile, incomes improved, but not enough to match expanding asset values. Suddenly, saving wasn't racing toward wealth, it was chasing increasingly expensive targets. Every dollar saved worked hard, yet asset prices worked even harder. Imagine running uphill while the hill itself keeps becoming significantly steeper. That's how modern savers often experience housing, investing, and long-term planning. The uncomfortable reality begins with inflation, misunderstood but constantly influencing outcomes. Inflation rarely announces itself dramatically before quietly reshaping financial possibilities everywhere. Prices gradually rise, reducing what identical amounts of money eventually purchase. Small annual increases seem harmless until compounded across decades of adulthood. Compounding works beautifully for investments and ruthlessly against idle purchasing power. This is where your parents encountered a completely different financial landscape. Interest rates were frequently much higher than what savers receive today. Banks sometimes rewarded savers enough to offset inflation's constant pressure substantially. Today, many accounts struggle matching inflation, especially during unusually expensive periods. Saving remains responsible behavior, but its financial mechanics changed dramatically underneath. Cash became less of a wealth-building tool and more preservation tool. Even preservation became difficult whenever inflation exceeded returns on savings balances. Then came another twist few people fully recognized while it unfolded. Central banks repeatedly lowered interest rates following recessions and economic slowdowns. Lower rates encouraged borrowing, spending, investing, and generally supporting economic activity. They also created powerful side effects spreading throughout financial markets everywhere. Cheaper borrowing helped push asset prices higher across housing and stocks. Existing owners benefited enormously as valuations climbed year after year steadily. New buyers faced increasingly expensive entry points despite saving responsibly beforehand. Ironically, caution sometimes became disadvantageous while risk-taking received stronger rewards. Financial success increasingly favored ownership rather than accumulation of cash alone, though. The game slowly shifted from saving money towards owning appreciating assets. Nobody mailed households instructions explaining these new economic rules beforehand, though. Many families continued following advice perfectly suited for earlier financial conditions. Save first, avoid debt, build cash, wait patiently for opportunities. Sensible guidance remained sensible, yet outcomes became noticeably less predictable. Consider housing, often the clearest example of this transformation today. Previous generations frequently purchased homes costing only several years' income total. Today's buyers often confront prices reaching many multiples of annual earnings. Saving longer should help, yet prices sometimes rise during waiting periods. The finish line keeps moving while disciplined savers continue approaching it. Many describe this experience as running harder without gaining meaningful ground. Then social media enters, showcasing lifestyles built around appreciating assets everywhere. People compare savings balances against portfolios, properties, businesses, and market gains. Cash appears boring while assets appear magical, effortless, and endlessly rewarding. Reality remains more complicated because asset ownership carries substantial risks too. Markets crash, bubbles burst, and leverage occasionally destroys financial stability. Yet long-term trends rewarded ownership frequently enough to shape expectations widely. This created another cultural shift around what wealth actually represents today. Wealth increasingly means controlling assets rather than merely storing accumulated cash. That distinction sounds technical but influences nearly every major financial decision. It changes retirement planning, home ownership strategies, investing behavior, and career choices. Even corporate behavior reflects incentives created by asset-focused economic environments today. Companies often prioritize growth, valuation, and financial engineering over simple profits. Investors reward future potential, sometimes more than present business performance. Asset values become central characters driving economic outcomes across entire societies. Meanwhile, many workers remain focused primarily on earning and saving wages. Nothing wrong exists there, but structural realities deserve honest examination. The old formula depended heavily upon conditions no longer widely available. Strong wage growth, affordable assets, and attractive savings yields mattered enormously. Remove those conditions and identical behavior produces noticeably different financial results. That's why conversations about personal responsibility often feel strangely incomplete. Individual choices matter, but environments influence outcomes more than acknowledged. Two generations can behave similarly while experiencing dramatically different economic realities. One climbed an escalator moving upward beneath disciplined financial habits daily. The other climbs stairs while the escalator sometimes moves downward unexpectedly. Neither story fully explains success or struggle without broader economic context. Understanding systems doesn't eliminate responsibility, it clarifies realistic expectations instead. It helps explain widespread frustration despite record productivity and technological advancement. People aren't imagining pressure when housing, education, and healthcare consume incomes. They're responding to genuine structural shifts affecting financial life every year. This realization changes how many approach saving, investing, and future planning. Savings still matter because flexibility, security, and resilience remain incredibly valuable. But savings alone rarely perform the same role they once did. Increasingly, they function as fuel rather than the entire financial vehicle. The destination often depends on ownership, productivity, and participation in growth. That may feel unfair, but fairness rarely determines economic outcomes consistently. Systems evolve gradually until familiar advice starts producing unfamiliar consequences everywhere. Most people notice only after years of disciplined effort pass quietly. By then, confusion replaces certainty and frustration replaces expected progress often. So the real question isn't whether saving money still matters today. The deeper question asks what saving money is actually accomplishing now. If wealth increasingly belongs to owners, what happens to savers alone? And if that trend continues, what future financial rules emerge next?